Hi. Uh, I had some notes and some strong opinions on CPI and inflation and some really, I think, good context for it all. And I was going to do some big thing on it, but there's just too much news going out, and I have a position again. So, silver, gold, and I have some crypto. They're moving as well. Plus, there's just more news coming out I'm trying to digest here. All right, so before it gets stale, this will serve you well, perhaps in the future when these things come up again when you read it. Plus, it'll help clarify what's going on right now, what's bullshit and what's not when it comes to inflation. There were a couple questions that I got privately after CPI, and the CPI number came out. The headline CPI came out unchanged to soft. The core CPI came out higher than expected, right? And what they didn't talk about was super core. So I want to go through and answer these questions for people. I have like three different points. They're related, but they're not the same. One is we'll talk about CPI, core and super core, headline core and super core, and how they say something is wrong. Um, we'll talk about the Fed's ability or lack thereof to fight inflation with current policy. I would just say, as an anecdote, if you remember how gold started to ignore interest rates and gold started to ignore dollar strength, well, everything is ignoring interest rates and dollar strength now. I mean, not everything. I'm generalizing, but what I'm saying is Fed policy, monetary policy, is less effective in general, and that's because we're not in a neo-Keynesian environment anymore. Anyway, but we're going to use what I just described as how to divide if the Fed's doing good or not on fighting inflation. And this is a tool that I've been using since probably 2010, but using it in very more intently now. Starting in 2021, when Posar made this offhand comment about goods versus services inflation. Okay, so that's the second part. And the third part is we're going to talk about what the bond market is telling us about cuts, if they're good or not. And that answers the three general questions. So here we go. All right, so CPI came out a bit warm, nothing to concern people about on the surface. And I want to take this opportunity. I'm reading a little bit of a script I wrote here. Hold on. Let's just go right to the main part. CPI is garbage. Okay, we know that. I'm not here to debate that with you, but I pay attention to it because garbage one month versus garbage the next month still shows me a trend in the only indicator we have that gets updated regularly. The garbage plus 2 percentage points is higher garbage, but it's better than nothing. That's the first thing. So that's CPI in general. Why do we even look at CPI at all? We don't take it seriously. We take its movement seriously. Now, what is headline CPI? That's just a number. That's the number without having anything broken out, whatever it is. What is core CPI? Core CPI is inflation with energy and food taken out. They say, and they're right, it's because those items are volatile. Energy and food prices are volatile. But here's why it matters. When you take out energy and uh, the reason core matters is not because they're lying to you by removing volatile items. I mean, they are, but that's not the point. The reason it matters is because of what it does measure. Core is a better measure of um, domestic inflation. Why? Because we don't import a lot of our food, but we import some food. And energy is theoretically out of our control. So you take energy out, and you could say, well, if you take energy out, inflation is not bad. And then you say, well, the reason you take energy out is because it's global, it's not in our control, and it's volatile. Anyway, in my opinion, core is also useless. Here's what's really useful, I think. Super core is what's really useful, right? And and these words have meanings. Okay. Super core Now, just speaking English, there are two types of inflation. There's goods inflation and there's services inflation. Goods is the higher price you pay for drywall, right? Or stereo. And services is the amount of money you pay the guy to install it. I mean, simply put, but it's that simple. It's stuff and help, goods and services. Now, just to let you know that all housing costs are in the services category. And that means rent, changes in rent, uh, mortgage differentials, all the fees involved. I mean, housing's huge. Okay, so that's what they are. So it's goods and services. So this is why core is useless. Core is only food goods. We want all goods in there. Now, the better way, maybe not better, but more importantly, is to divide it into inflation into those goods and services. So goods are imported for the most part because we don't make anything anymore. Services are essentially labor costs. Goods are prices of things outside of our control. Services are prices of things on land. Yeah, we pay higher prices for things that we buy. And so that's the whole point. So when you go to Supercore, you're taking out all of the stuff we import. You're left with domestic inflation, what we're supposed to control with Fed policy. Now, when we manufactured stuff, we controlled goods inflation too by raising rates because that our industries would make less stuff. But all we are is consumers in that respect, right? So domestic inflation for Fed purposes is services inflation. So massages, doctor's visits, manicures, housing costs, shelters costs, as they all call them. Now, why do we care about this? Is this like an academic exercise? No, it's not. See, if you understand Supercore and the goods services thing, you can see if the Fed's doing their job. See, when the Fed raises rates, the first thing that's supposed to drop is Supercore, because Supercore is you get fired, you don't get a raise. Okay. Well, I'll give you some more examples. I have more examples peppered throughout this. So um, you will, let's talking about just going back to goods for a second. So if the Fed raises rates, you'll buy less luxury goods, but you'll still buy necessities. So that's why core is useless. They can raise rates, but we still have to buy food. We still have to put gas in our cars and heat our homes. So when you strip those out, the Fed doesn't really have to panic. I mean, panic over inflation they can't control. So that's one of the reasons I think that he was so slow to hike, because he was expecting oil to come back down. That was a big mistake because, anyway, for different reasons. So, but back to services, then we're going to stay on services. That's where rates are supposed to work, slowing the economy so housing costs and labor costs stop rising. People travel on vacation less. It's also a bigger factor in job security. If rates are higher, businesses can't expand their finance cheaply. They fire people and they lower prices. Your HVAC pal, until recently, would decide to not hire an apprentice because the people that were going to do an upgrade on their home, the interest rate is too high. And so they're not going to borrow money to fix their home. And so the HVAC guy is going to lay someone off. Right? So it affects everything, especially in housing and labor. Now, in the past, that's how it worked. You look at Supercore, see it coming down, and say, okay, the Fed's uh, medicine is working. We just have to wait for energy to come in line. So goods inflation will follow later. But in 22, something changed. Lots of things changed, obviously, really. Well, 20 is when it started to change. When COVID happened, supply chains changed. We had to compete for goods that we used to get exclusively. When the flight out of blue states happened, people moving homes, housing prices went up, was because we didn't have enough homes in the places people wanted to move. We have enough homes in the country because people live in homes. We didn't have enough homes in places that people wanted to move. So people with money paid premium to get their new home away from the blue cities. Rezoning is the issue. So, for example, you're in New York City. Let's say you're a really rich guy in New York City, right? Wealthy family, right? You're Upper East Side. And you say, screw it, I want to move somewhere else. And you want to move to, I don't know, someplace in the Midwest, right? The price is cheap, right? The land is cheap. And so you just buy it. You just say, fuck it, I'll buy it. Excuse my French. You buy it. Now, the reason this was so slow to develop is because in New York City, everything is already zoned for more building, right? It's like, whatever your footprint is, a quarter of an acre, a tenth of an acre, whatever. It's already zoned. But in rural areas, it's not zoned. So you have to get zoning permits. And you have communities that start getting nervous. And so it's like, okay, they had a minimum of 2 acres, and now real estate guys are coming in, they want to get it down to 1 acre, and this takes a lot of time. And then you're building the houses. Okay, so that's one of the reasons the pipeline got so bottled up with housing. We don't have enough housing in the places people want to live, and that's a trend that won't change. So that's the important part. So raising rates as a result hurt people who need a mortgage, not people who don't. And so cheaper prices got scooped up. It's like when I was a kid, they would say that if you went to Hawaii, everything was so expensive because the Japanese yen was so strong. They would just come in and just buy stuff. They didn't care about the price. And so people that don't have financial means can't get anything because it's just being bought by wealthier people. Yeah, a surge of them, right? A GOP flight, a blue state flight. All right, so what this did is it kept labor costs staying high and it kept housing going up. So there are many reasons for this, but one of the big ones is labor unions were encouraged to strike. So services inflation on the housing side went up. That's one reason, right? Because of everything I just described. And then on labor side, Biden encouraged them to strike. It just blew me away. He was encouraging unions to strike for higher pay while we were being given money to survive. The $600 thing. So those strikes produced 5-year contracts, roughly, permanently embedding higher wages into CPI. That stuff doesn't come out until someone loses their job. So if no one's negotiating contracts and the Fed raises rates, maybe you'll get fired. But if people are going on strike and they're getting raises, well, you're baking it in, right? And no one got fired because everyone wanted to buy a house. Everyone had too much money. It's funny to say that, but so meanwhile, inflation did drop significantly, and it dropped for another reason. We got goods inflation down by emptying the SPR, and the rates worked. So moving back to the goods inflation. Why did goods inflation drop? Well, you raise inflation enough, and people spent all their money on they stopped spending their money on goods, right? They started taking more travel time, more vacation, buy an RV, see America type of stuff. And as they started to run out of money, we stopped having demand for Chinese goods, let's say. And the energy was sticky, though. So the energy being at a high price means those goods still remain relatively expensive because you need energy to make them and ship them. And so we emptied the SPR. So the Fed was supposed to get services inflation under control while the government quietly got goods inflation under control by dumping energy. And it worked. We got energy down, and in combination with the fact that nobody wanted to buy any more TV sets, nobody needed any more flat screen TVs, goods inflation started to back off. But what really never backed off? Food, right? And our food, a lot of our food is domestic. So why are food prices staying up? It's rhetorical. They're staying up because we have real inflation now. All right. So people talk about tariffs on imports as well. Actually, let me back up a little bit. All right. So let me just read a little bit of my script here. Those strikes produced 5-year contracts permanently embedding higher wages into CPI. That stuff doesn't come out until somebody loses their job. Fine. Meanwhile, inflation dropped for another reason. Biden emptied the SPR. Obama and Clinton did it too. Democrats do it a lot. I don't know why. It's just a thing. But emptying the SPR drove energy prices down, and that's what slowed inflation, not Powell's rate hikes. Core inflation stayed sticky. Super core inflation stayed sticky. And what is super core inflation? Super core inflation is only domestic services, labor and housing. So super core is really the cost of labor to live in America. And super core is now marching higher. And I'll include a chart, but all those union deals and cost of living adjustments, COLAs, are baked in permanently until people literally get fired. Just like we said, the floor for gold has been raised, the floor for inflation is now permanently higher. So the Fed talks about, so moving on to when the Fed talks about the wage, someone asked about the wage price spiral. The wage price spiral is what they call it, but what they really mean is a price wage spiral, meaning the price of goods goes up, workers demand higher wages because the economy is doing well, they get them, and then they chase the goods, and then goods go up again in price. So that's documented. You get a raise, you spend more money. And then the company says, well, I have to raise prices because I gave you a raise. And, it's a snowball effect. But in 2020, 2021, 2022, it wasn't prices going up that forced wages higher. It was higher wages and money that forced prices up. Trump in the beginning, and Biden handed money out to everyone and then told them to go on strike. So fiscal stimulus gave everyone more money, and then the strikes locked in those raises. So the long story short, super core is trending up, and it's not something it's not volatile. It's stable. Super core is one of those, like a moving average almost. It's just marching higher, and it's not coming back down. Inflation's floor is rising, and in my world, that's just as important as the floor for gold. Now, about yesterday's actual report, it was lukewarm and didn't damage rate cut expectations in the market, right? In fact, the market started pricing in more cuts, and that may happen. But here's the twist. Now we're moving on to bonds. Long-term rates went higher. They've since backed off, but long-term rates knee-jerked higher on the information. So when CPI came out, and it came out to the stock people that it wasn't bad enough to stop Powell from cutting, well, short-term rates dropped and long-term rates went up. And this is key to understanding, to processing when someone cuts. All you have to do is, you've heard me talk about things like the broken bond ladder and the seesaw and the shift. Well, I'm going to describe it another way in simple macroeconomic terms. When a real recession is coming and the market expects cuts, long-term yields drop too. Short-term yields drop and long-term yields drop. Why? Because money comes out of money markets and says, I'm going to go into longer-term yields to lock it in. And money comes out of stocks, fear of recession, and goes into long-term yields. But when you cut rates too early, short-term rates drop and long-term yields go up. That's your seesaw thing. And what the market is saying is, you're cutting rates too soon, inflation's not dead. Remember, there are two ways to fight inflation at the government level. One is to raise short-term rates, raise them. And the other one is to, and I'm putting it in quotes, air quotes, to quote, permit, end quote, long-term rates to go up. Now, why? Short-term rates go up, money slows down. That's what they say. That's what's supposed to happen. Long-term rates go up, well, then it becomes more attractive and people start putting more money in there. So the long-term rates offset the inflation eventually. If we have 10% inflation, then you want 12% bonds. Otherwise, you're not going to buy a bond. So what happened yesterday and in September of 2024, when he cut before, is short-term rates went down and long-term rates went up. Now, that's a bad sign. And it's a bad sign because the last two times that happened in a big way were 1999 and 2008. And what happened then was long-term rates were creeping higher and stocks were rallying with it. So you can get a 5% bond yield, I'll buy stocks. You get a 6% bond yield, I'll buy stocks, right? You still, the higher the yield was going, the more stocks were being bought. It's like people were accelerating, pulling their money out of bonds and FOMOing into stocks. And then it reaches a point where it's like, wait, that's a really high rate. And everybody goes out the other way. So it's like a pilot. It's a bag holding thing. In 99, that happened. In 2008, that happened. In 2008 was easier to see because rates were going up as oil was also going up. This time oil that's why they opened the SPR. They wanted to keep oil down to make it not be a problem like it was in 08. So what happened yesterday was the market said we're going to cut rates. Whether we don't know what Powell said, but the market said, oh, they're going to cut rates, and stocks rallied. The dollar weakened, short-term rates weakened, and long-term rates went up. Not much, but enough. And that is a sign that we're cutting too soon. That's what happened. Powell saw the same thing last year, as I just alluded to. He cut 3 times in September, October, November, December, 3 times, right? And bond yields rose. The market basically told him, you're doing the Liz Truss. You can't do that. So if he cuts now, the bond market's going to price in I believe, unless they do yield curve control. They're not there yet. But if he cuts now, the bond market's going to price in a boom, not a slowdown. The bond market's going to rush all of its money out of stocks, out of bonds, 30-year bonds, and put it into stocks and commodities because bonds won't fight the inflation anymore. The inflation is going to go up because the Fed's cutting rates. And so you buy something that's going to go up. And that's where we are. We're in a K-shaped recovery. If Powell cuts rates, if you're hanging drywall, you're fine. If you're in finance, you're fired. It's the reverse of the 70s. I'll attach a Supercore chart so you can see exactly what I'm talking about. But one last thing, because I'm thinking that inflation's back. Put it this way, inflation hasn't gone away, and I believe there's a really good chance Powell's not going to cut, and I think the market is just praying for it. A couple things to be aware of. If they redo how the jobs numbers are calculated, we might get a big cut in how many jobs have been created over the last 2 years. Like there could be a total revamp, and that's possible. That's the first thing. The second thing is if AI is kind of like a rate cutter for them, so or a rate hiker. I don't know what it is, but it screws everything up. If we have inflation, they'll implement more AI. It's almost like they'll let it out of the bottle a little bit more. If we don't have any inflation, then they'll do something to slow it down. I don't know how, but you could see what's happening now. Corporations are saying we're laying people off for it. Now, why are they doing that? Because they need to stay competitive. I talked about this in a previous post. And they're negotiating with the government. We want a tax abatement or something like that. So anyway, I believe super core inflation is marching higher, like a very slow moving average. And when you look at that, you say, and you're going back to the first point, the Fed's job is to fight inflation by raising rates. And the inflation they're supposed to fight best is domestic inflation. And they've done none of that up to par. The Fed is not important. And they're not as important because you're in the face of fiscal dominance, which is a phrase everyone's using, but it's right. Fiscal dominance is trumping monetary easing or monetary tightening. And that's it. That's the way it is. I'll include the chart. Hope I answered everyone's questions. and I'll catch you later.